Hello, everyone. Thank you for joining today's KPMG webcast, where we will discuss private equity, asset managers in Brazil, tax structuring, tax M&A. Hopefully, it will be very insightful for everyone here. My name is Eric Amaral. I'm the head of international tax and M&A tax based in São Paulo, KPMG Brazil. We have a very, very good team of colleagues here that will be the speakers, if you allow me to introduce them. We have Sam Heisenberg. Sam is based in the US. He's the principal in KPMG US, and he's leading the Washington National Tax. We have also Roberto Haddad. Roberto is our international tax and M&A tax partner based in Rio de Janeiro, and he's our leader of the PE sector within KPMG Brazil. We have Abílio Machado. Abílio is an international tax and M&A tax based in São Paulo, and Priscila Antunes, who is also a tax partner based in São Paulo. Before we get started, we would like to two or three very quick administrative topics. First of all, we have if you are interested in the CPE points, we have some comments here. First of all, if you are interested in the certificate of attendance, you are of course required to be registered, logged in, and take part in the online questions that will pop up on the screen. Of course, those that are not interested in the CPE points, you don't need to answer the question, but the polling questions will appear on your screen during various sections of the webcast, and you must respond at least 6 out of 7 polling questions, okay? And of course, you have to participate in the entirety of the webcast. All participants, number 2, all participants will be on a listen-only mode. And of course, if you want to pose questions, you can of course use the Q&A box, which is on the right side of the WebEx screen. And at the end of the presentation, we will have the Q&A session, okay? And finally, if you have any kind of technical issue, of course, you can use the Help tab at the top of the WebEx screen, or if it doesn't resolve, you can submit, ask for help in the Q&A box as well, okay? So having said that, without any further ado, let me jump into our agenda for a second. So we have the introductions, then we're going to talk about very briefly about the private equity asset managers landscape in Brazil. Then we have some insights as far as the due diligence following the normal deal cycle. After some insights and some points regarding the due diligence process in Brazil, very insightful, we have some topics covering tax structuring, how to structure the investment in Brazil, the usual approach. Then we have some slides on value creation, tax value creation. And finally, we don't have crystal balls, but of course, we are going to spend a few minutes discussing what kind of tax reform, what kind of tax change may occur in the future, and how those changes may actually impact your business. And then we have the Q&A session at the end, okay? So without further ado again, I would like to invite my colleague, Roberto Haddad. As I said before, he is the leader of our private equity sector within KPMG Brazil, and Roberto will provide us with an overview of the landscape here in Brazil. Roberto, please.
Thank you, Exxon. Hello, everybody. It's a pleasure to be here. My goal here is to provide you with a brief overview on what is going on for the PEs and what we have been seeing over the last months for the private equity and venture capital industry here in Brazil. So just to give you an idea, we do have many maybe most of the private equity funds, international funds in Brazil. They are based in Brazil for a long time. They've been investing for more than a decade in Brazil. We do also have a lot of international asset managers. We also, well, of course, we do have many locals, very strong local private equity and asset managers, but I would like to focus in the international funds that are based in Brazil. We also have many sovereign funds that are also investing in Brazil, especially in infrastructure. And I would say that we do have a pretty strong fund industry in Brazil, and it's growing. I would say that on the other side, we run a research every year, and now we're doing that on a quarterly basis. And this research is just to understand the volume and amount of investments, the exits and everything involving the private equity and venture capital funds. And when we look at Brazil in the year of 2019, we had 0.35% of the investments of the GDP of investments of private equity and venture capital in Brazil. So if we compare the amount of investments to the GDP, we have 0.35% in Brazil. If we compare to the US, in the US we had in 2019 1.68%. So that shows more or less that we have a long run to get maybe comparable to a nation as the US, and this maybe brings more or less the size or the opportunity that we may have in Brazil. Apart from that, in this research, we could see that even in the last month, last quarter, in the last month, where the world economy was greatly affected by the effects of the pandemic, the activity related to the private equity and venture capital industry reached relevant levels. So they were pretty strong and resilient. So I would say that that was some good news. And something very interesting about this research is that in the last quarter, we noticed that for the first time ever in Brazil, we had a bigger volume of investments in the venture capital coming from the venture capital funds compared to the private equity funds. So that was in volume and amount of companies invested. So that was something very different. We are seeing that the average ticket that the venture capital are paying for the investments are increased a lot. So that's something that we are looking at, and venture capital is getting more relevant and significant in the markets. Just a quick comment on the type of investment that these funds are investing in Brazil. So we have retail, healthcare, infrastructure, water management, a big investment now, energy, including clean energy, technology, agribusiness, telecommunications. All of these industries are being invested by the private equities. When you look at the venture capitals, they are investing largely in fintechs and health techs. Just to give you maybe a final comment, we are seeing now big activity on IPOs. Some IPOs already happened and many to come. And we see that maybe in a couple of years we'll see maybe a much more sizable market of public companies. So, and this is being largely motivated by the funds. So you know that in one of the most important exit strategies of the funds is the IPO, and they are implementing that, and we are seeing a lot of movement in Brazil. So this is very, very significant. And of course, on the other side, the funds in Brazil, they are seeing some competition because in one side, there are some companies that are choosing to go to IPO instead of having a PE before that. And we also have a different market now of credit. So the credit in Brazil is much more cheap than it was in the older years. So I would say that some companies are electing to get some cheap credit instead of having private equity. But in the end, I would say that Brazil is doing very well. and the funds, I think they are increasing a lot of activity. So we have seen in the last month some big fundraising coming from the private equity funds and venture capital, and a lot of investment made. So we are quite excited about what is coming, and when we see this crazy year with a lot of challenges and seeing the industry growing, that's a good sign, and I think we should be coping on that. So that were my comments for now, and I'll be here if you have any questions. It'd be a pleasure to answer you. Thank you.
Thank you, Roberto. Thank you very much. Very insightful. So the next topic, guys, is of course one of the first steps in an investment is the due diligence. So the goal here is to present you some insights as far as the Brazilian environment. Of course, we are not going to discuss tax topics, specific tax exposures. It doesn't make sense. The idea is to spend some minutes to give you guys a better view of the environment, some insights, how to conduct due diligence in Brazil. And in order to do that, my colleague, Abilio Machado, again, tax partner based in São Paulo, will be leading these topics. So Abilio, please go ahead. Thank you.
Thanks, Erickson. Good afternoon, everybody. Thanks for joining us for the session. As Erickson already anticipated, the idea here is, to go through the topics that, based on our experience, are the key elements that someone looking at investing in Brazil should have in mind, especially someone that has never been experienced, that has never had an experience investing in Brazil earlier. So, Erickson, I think if you can move to the next slide. We have selected here some topics. I think the first and most important thing that everyone should have in mind is that perhaps unlike in other jurisdictions, succession rules in Brazil are very broad. So, when we are discussing with our clients' deals, sometimes the seller comes with alternatives to try to shield some problems, such as asset deals, the spin-offs, drop-downs, or creating clean new companies. And ultimately, although some of these structures may difficult certain situations to be identified by the tax authority, the end result is that ultimately is nothing completely shields the buyer from a potential existing risk from the target company. The direct result of that is that when you look at the Brazilian deals, it's fair to say that a good portion, I would say that more than 90% have some sort of escrow or retention of purchase price mechanism embedded, so that the buyer can be protected from anything in the future. Another thing that is very important to keep in mind that this is something that sometimes, since it's not a problem in other jurisdictions, it's not in the back of the mind of an investor, is that the Brazilian indirect taxes are not comparable to the European VAT, for instance. And the first thing that you need to have in mind is that the Brazilian indirect taxes are not only a pass-through due to the way that they are calculated, sometimes on the top of the total price, embedded in the total price, and the way that the tax credits are taken on the VAT-like taxes that we have here, they have a direct impact on profitability. So they need to be looking at very careful. Another very key element of the indirect taxes is tax incentives. Although tax incentives in Brazil are in the process of being extinguished, they're still present. A lot of states granted incentives for business to establish in the region. And sometimes when we look at the P&L and make a thorough analysis, you can reach the conclusion that tax incentive is the only competitive advantage of the business that you're trying to acquire. So, especially now that they're in the process of being terminated by a recent legislation they need to be looking at very careful. Another thing that often happens when you are analyzing an investment is that you find out that there's a lot of gray areas between the numerous indirect taxes that you have in Brazil. And that is very much true now in the digital economies. You know, sometimes you look at the business and there's a significant question of whether that should be, you know, paying taxes to the state authorities, to the city authorities, and sometimes no taxes at all. And, you know, another clear characteristic of indirect taxes is that they are very complex, and it's not uncommon that targets may have not observed a certain procedure in detail, and you know, any adjustment on those procedures will have a significant impact in profitability or EBITDA of the analyzed investment. Another characteristic of our market is regarding aggressive tax procedures. There's still a reality in Brazil. You know, Brazil has gone through an implementation of an electronic tax system called SPED. We have electronic filings which are sent to the tax authority on a monthly basis with a high level of detail. We also have electronic invoices, so the government knows on a real-time basis to who you are invoicing, the price, and the taxes applied. And the implementation of the system has reduced informality and aggressive procedures dramatically. But the fact is, some of these procedures are still a reality in the Brazilian market, such as off-book sales, dumb invoices, and other things that needs to be checked carefully because the penalties are very high, and a result of that, of the existence of such procedures is that very often they kill the deals. On the labor side, one thing in the Brazilian market that is particular to the Brazilian market is that we conduct a labor due diligence alongside a tax due diligence in basically 90% of the project. And the reason of that is the complex Brazilian legislation protective of the Brazilian employees. Certain procedures such as, for instance, a very significant one, hiring full-time employees as contractors can reduce the payroll costs, can generate significant exposures, and sometimes, especially for investors that don't want to keep that, which can impact profitability very significantly. And you know, together with other procedures from the labor side, such as payment of bonus, stock options, which sometimes are not included in the calculation basis of social security taxes, they also need to be analyzed very carefully, or otherwise we will be inheriting potentially very significant risks. If you can move to the next slide, please, Erickson. I already touched on that. The Brazil has a very highly complex tax and labor filing system. And the result of that is nowadays we still have companies, and that's very common, that are not able to comply with the delivery of these monthly and electronic returns. And the first point that needs to be taken in consideration is that lack of compliance can result in very significant penalties. Very often such penalties are calculated based on the revenue of the company. So any exposure related to that can be a very big problem. And another thing is that if you buy a company that has not been compliant of that with these filings, and one reason for that, for instance, is using an international ERP that is not prepared to handle Brazilian filings, you will spend a lot of time after the acquisition, time and money, trying to adapt the system and adjusting anything that was not done correctly in the past, and we have seen this movie perhaps many times. Another thing that you need to have in mind when entering Brazil is that litigation, tax and labor litigation is very much common. So if you look at the company and see that it has hundreds or perhaps thousands of ongoing litigations, that's not completely unusual in the market, although Brazilian labor rules have undergone gone through a reform in 2017 that have improved that scenario in several aspects, but it is still an issue, and it needs to be considered and addressed properly in the SPA. And on the tax side, Brazil doesn't have a very strong settlement system, so everything is resolved through litigation. So it also takes quite a long time to resolve this litigation. The result of that, and also to talk a little bit about something that troubles our finance colleagues, is that accounting is usually for tax compliance only, and it doesn't necessarily helps you to get a good financial view of what's going on in the company. So during the due diligence, a lot of time is spent trying to rebuild the numbers and reconcile accounting numbers with management provided information. I think if you can go to the next topic, Erickson, this is just a quick summary of what sometimes happens to the PE on the buy side and the PE on the sell side as a result of this brief scenario that I tried to demonstrate here. On the buy side, you will try to get full indemnification clauses, have a very good attention paid to tax and labor elements that can impact the value of the company, the EBITDA of the company, and also other elements such as working capital and net debt. Escrow retention provisions, as I said, it's very common, and address decay risks in the contract is an imperative to have deals completed in Brazil. On the sell side, the PEs often face the problem whenever the asset has tax issues, which is the need to liquidate funds, make the escrow a little bit difficult. So especially for PEs during the deal cycle, we will talk a little bit about that further ahead. Responsible management of the tax affairs and value creation that also takes a look at tax is very important to a successful exit on deals here. So I think, Erickson, from my side, that's the brief overview of what I have here in Brazil.
Thank you, Abilio. Thank you very much. I think it was very insightful. Everyone can appreciate the relevance, the complexity and relevance of the due diligence whenever doing business or investing in Brazil. And if you guys allow me, I would like to bring to our discussion my U.S. colleague, Sam. Sam, I think we have a question for you. Of course, you have been assisting private equities and asset managers doing deals in the U.S. and also in cross-border transactions. So given everything that Abilio said about due diligence in Brazil, the whole process and the insights, do you see, based on your experience, anything that captures your attention, take into account a foreign investor or a U.S. investor, trying to do a due diligence in Brazil?
Yeah, it's a really good question, Eric. And Abilio did a fantastic job summarizing some of these issues. But the points that I would pull out is, as a relative matter, Brazil has two things going for it. It's a very sophisticated tax system, right, with federal, state, withholding taxes and direct taxes, as Abilio mentioned. All of these issues And the second thing is the tax rates, and particularly the effective tax rates, are relatively high. There very important, and the partner that you're bringing to the table to do that tax diligence for you is going to essentially be
Sam, I'm sorry. Your voice is a little bit up and down. You know, can
okay.
you? Now it's better. Yeah. Can you?
Okay. Yeah. Sorry, I'll get a little bit closer. The main point that I was making was it's really important that we have a strong tax due diligence provider in Brazil because of the relative sophistication and gray areas in Brazil and Brazilian tax, and the relatively high effective tax rates that do apply. And so this is going to be a differentiator, possibly, and you need to have a very strong due diligence team on the ground to look through these things. That is not necessarily true in other jurisdictions.
Okay, Sam. Thank you very much. Let's move on then. Thank you. Again, considering the deal cycle that we have in mind. So after the due diligence, let's say the due diligence is moving forward very well. And now we want to have, you guys as investors, you want to spend some energy when it comes to tax structuring, how to organize your investment, how to structure the investment in Brazil. And then myself and Priscilla, my colleague, we are going to tackle this topic here. First of all, let's start with this picture here. That's a kind of simplified depiction of the usual structure that you see when private equities and asset managers are investing in Brazil. Everyone probably has heard of the FIP or FIP. So that's the structure that we are going to explore here today. Of course, there are variations, but of course we have just 60 minutes, 70 minutes, right? The whole webcast. We cannot explore every single variation. So we're going to focus on the FIP. So it's very tax efficient for asset managers and private equities, as long as you are able to comply with the requirements, of course. Mainly because of the exit, you are able to achieve a tax-free exit, which is usually a very important component of the overall return of the private equity or asset manager. Just one additional comment. As far as real estate, we have also the Real Estate Investment Fund, the FII. It's a kind of Brazilian REIT, very similar to the US REIT. We are not going to explore this particular structure here. But of course, real estate investments, they also make use of the FIP whenever applicable. And also infrastructure, private equities, and asset managers. And finally, in order to simplify the concepts here for you guys, in order to try to be as concise and as clear as possible, we are going to have a top-down approach. We are going to start with the offshore structure, then we descend to the FIP, then to the holding company, and to the portfolio company. Okay, so I hand over to Priscilla to help us guide us through this very famous structure.
Thank you, Erickson. So SIPs are widely used by global investment, private equity funds, and pension funds, and other institutional foreign investors doing business in Brazil. And one of the reasons for that, as you mentioned, is because SIPs may entail withholding income tax at zero rate on distribution to foreign investors and upon the exit of the foreign investors that comply with specific requirements. So if you are a foreign investor and you are able to comply with these specific requirements, the income and gain embedded in the distributions made by the SIP and the exit of the foreign investor will be subject to withholding income tax at zero rate. As far as the requirements for the applicability of the SIP tax benefits to foreign investor, first of all, the foreign investor individually or along with related parties should hold less than 40% stake in the SIP and should be entitled to receive less than 40% of the distributions made by the SIP. This is the so-called 40% rule. And so with regards to private equity funds, we know that some private equity funds may use an aggregator. And under a FIP structure, an aggregator will actually hinder the applicability of the FIP benefit. And in addition to the FIP 40% rule, the foreign investor shall not be located in a tax haven jurisdiction. So if the private equity fund has a tax haven jurisdiction embedded in the structure, an alternative that we have implemented in the past is the creation of an alternative investment vehicle, an AIV, to carry out the investment in Brazil and to secure the applicability of the FIP tax benefit. So in a nutshell, if you are a foreign investor and you are able to comply with the 40% rule and you are not located in a tax haven jurisdiction, you will be able to benefit from the withholding income tax at zero rate on the distributions made by the FIP and also on the exit. With regards to the tax requirements applicable to FIPs, an additional comment that we have is that FIP structures are under the radar of the Brazilian tax authorities. Last year, the Brazilian tax authorities assessed and issued infraction notice to some FIPs that were allegedly not compliant with the FIP tax requirements. And the Brazilian tax authorities were targeting investors that were benefiting from FIP structure without actually complying with the tax requirements provided by the tax legislation. And the tax authorities were mostly concerned about the beneficial owner of the FIP distribution and also the role of the GP, the general partner. So we know, of course, that the GP is an agent and that the investors are actually the LPs, and that eventually the private equity fund will have their own skin in the game, which will usually be just a small portion of their overall fund. But if everything in the structure indicates that the GP actually control the entities that are investing in Brazil based on the LP and partnership agreement on the governance, the structure might be challenged by the Brazilian tax authorities. So, of course, that the risk of challenge by the Brazilian tax authorities will be based on the facts and circumstances of each case. But the most important takeaway is that the FIP structures are under the radar of the Brazilian tax authorities. So in order to benefit from the withholding income tax at zero rate, the structure and the investment in the FIP should be compliant with the tax legislation. And in this respect, there has been an important and positive development. The Brazilian tax authorities last year, they issued an interpretative declaratory act confirming that the applicability of special tax regimes should be determined based on the jurisdiction of the direct foreign investor, except in cases of fraud and misconduct. So with regards to FIP, that means that the applicability of the FIP tax benefit should be based on the jurisdiction of the foreign investor that holds direct stake in the FIP. This is an important milestone that shows that the Brazilian tax authorities are learning about the private equity industry, but in any case, it is important to be careful and to be mindful of the tax requirements provided by the legislation to avoid risk of exposure in Brazil. Now, moving on to the next. Yes, thank you. So we talked about the requirements for foreign investors to be able to apply the FIP tax benefit. And now we will talk about very briefly about the regulatory rules applicable to FIPs in general. So FIPs are subject to the Brazilian Central Bank and Brazilian Securities Commission rules and register. And with regards to the FIP portfolio, it should be compliant with the CVM regulation. The good news is that the CVM regulation is actually relatively flexible with regards to FIP portfolio. So FIPs are allowed to invest in stocks debenture, subscription bonus, and other securities convertible into shares, and also to invest in limited liability companies. The most important rule regarding the FIP portfolio is that the FIP must hold influence over the portfolio company. Otherwise, the FIP will disqualify for regulatory rules. And apart from the FIP portfolio, an additional aspect of the CVM regulation is that the FIPs are allowed to issue different classes of quotas with different political and economic rights. And this is important because it gives more flexibility to FIP investments, and it's possible to accommodate different investors. And as for the tax requirement for FIP portfolio, so the tax requirements for FIP portfolios are not 100% aligned with CVM regulation. And but in spite of that, the Brazilian tax authorities already indicated their intention to align the tax requirements with CVM regulation. In 2017, the Brazilian government issued a provisional measure 806, that introduced significant changes to the tax treatment applicable to some Brazilian investment funds, including FIPs. And with regards to FIPs, some of the changes on the tax treatment were actually based on the qualification of the FIPs as investment entity and non-investment entity. So in principle, based on the provisional measure 806, there would be no changes to the tax treatment applicable to FIPs qualified as investment entity. On the other hand, FIPs qualified as non-investment entities would be subject to the same taxation applicable to regular legal entities. So based on provisional measure 806, it appears that the Brazilian tax authorities were aiming to tackle the use of FIPs as a disguised holding company. So although provisional measure 806 was not approved by Congress and was not converted into law, it is expected that that similar tax rules aligned with CVM regulation will eventually return. Erickson, these are the topics that I wanted to cover today. And before we move on, I have a question to Sam. So Sam, I would like to hear your thoughts on the key U.S. tax aspects involving FIP structure. And in general, what are your main concerns when we have to shift the investment structure to an AIV?
So this is a very important point that we need to really try to work through. The FIP structure is from a U.S. holding perspective fine the way that we're currently proposing it, and that should work. We can normally do this without creating too many different U.S. tax issues for the funds. However, that's not always the case, and so we really need to take this on a case-by-case basis. It does also raise some questions for U.S. taxable investors, with the different, if we need to structure an existing fund in a different way. This needs to be thought through very carefully. And if we're going to be looking at using this structure instead of the structure we've been doing in the past, these are also things that will need to be worked through. But I can tell you that in almost all circumstances, the art of the possible, if you will, is that we can do this, and that this will be possible to do, and will not have adverse U.S. tax consequences, but it does require very close coordination between the Brazilian tax team and the U.S. tax team to make sure that we're okay.
Good. Thank you, Sam. Thank you very much, Priscilla, as well. Let's move on to the next page here. We are still, guys, focused on the FIP structure. We will post some comments here. So after Priscilla, she talked about the offshore structure, a little bit about the FIP. So now let's talk about the deal, right? So you have the deal. Now the private equity, the asset manager has to inject cash into the FIP. So that's the first bullet point here. There is no IOF, just for those that are not aware of the IOF. This is a financial transactions tax that exists in Brazil, and when you make an investment in a normal legal entity, 0.38% IOF would be triggered. 0.38% may sound too small, but if the deal is sizable, 0.38% becomes something relevant. So there is no IOF when you make the investment into the FIP. That's the first advantage. So then we have the typical structure that we tried to depict here. We have the FIP, usually, not always, but usually we have the holding company, the acquisition vehicle, and then we have the portfolio company that will be acquired, in which the holding company, the acquisition vehicle, will make the investment, right? So the holding company, the acquisition vehicle, of course, it's a normal legal entity. It has to be VSA. As Priscilla said, CVM and the tax legislation, they are not completely aligned. So in accordance with the CVM regulation, the holding company could be a limitada, a limited liability company. But in accordance with the tax legislation, you should keep this holding company as a SA, a corporation, in order to get the beneficial treatment applicable to the FIP. So the holding company, the portfolio companies, they are legal entities. Each of them they are different taxpayers because we don't have tax consolidation in Brazil, right? So they are normally subject to taxation, those two entities. As far as profit distributions, of course, your profit will be generated by the portfolio company. The portfolio company will tax the profit by corporate income tax. Remember that in Brazil, corporate income tax, the nominal rate is 34%. But then after the taxation, the portfolio company can pay dividends to the holding company without any taxation. There is no taxation upon dividends in Brazil in accordance with our internal legislation. So dividends can flow from the operating company, the portfolio company, to the holding company, and then from the holding company to the FIP. The FIP will not be subject to taxation by default, and then the FIP can make distributions to the investors. And of course, as long as you comply with the legislation, no withholding income tax, no taxation will be triggered upon the FIP distributions. Okay. Of course, if you do not comply with the FIP, as it's indicated on this page here, you have 15% withholding income tax when the FIP makes distributions to non-compliant investors, right? We're going to talk a little bit later, but anticipating the most key point in terms of the overall game here, which is the exit. Again, assuming we comply with the FIP regulations, with all the tax details, and there are many details. In case of exit, the FIP usually sells the portfolio company or the holding company to the potential buyer. The capital gain will not be taxable at the level of the FIP by default, in accordance with the legislation. And then the FIP can distribute, can return this capital, the capital gain, to the investors without further taxation, again, assuming that the FIP is compliant with the legislation. If there is no compliance, 15% withholding income tax would be triggered upon the distribution of the capital gain by the FIP. That's the overall game. We will move on to the next page here, where we have some further details. So then why we have this holding company, why do we need this holding company? First of all, we had a very positive change recently, which was a change in our legislation involving funds in general, including the FIP, defining precisely that the quota holder of the fund has limited responsibility, right, legally speaking. Before such change, things were a little bit blurred. So the holding company used to play this role, as a blocker, legally speaking. Nowadays, it's not that relevant. But another key point is acquisition finance. Many deals, we have seen many deals in Brazil where, the funds, they come, of course, partially from the equity investments, from the investors, from the fund. But also we have local debt, debentures or a debt with a bank. And the role of the holding company here is to take on this debt. Why? Because the FIP, in accordance with the regulatory framework applicable to FIP, FIPs are not allowed to take on debt or issue debentures. So if your deal is funded partially through debt, you need the holding company in Brazil in order to be able to take on the debt or issue the debenture. There is no IOF in case of debenture, for instance. In case of a normal banking loan, there is IOF, but until December, because of COVID-19, the government has reduced the IOF to zero, right, until December, in case of loans. In case of debenture, it's zero, right? Another example why you should have this holding company is, of course, the famous goodwill asset step up that you may have in Brazil. So usually you have the acquisition vehicle. The acquisition vehicle takes on the debt, makes the acquisition, and then because we have a local acquisition in Brazil, given the Brazilian accounting rules and tax rules, the holding company, the acquisition vehicle will be able to recognize, depending on the numbers, of course, a step up in the basis of the assets of the portfolio company, as well as a potential goodwill, okay? Nothing happens after the recognition, but at some point we have to merge these two companies because we don't have tax consolidation in Brazil. So if you keep the holding company, the goodwill, the asset step up will not create any tax advantage. So we need to merge the two companies. And of course, as it's written here, we have the Upstream Merger, whereby the acquisition vehicle is the surviving entity, or the Downstream Merger, whereby the portfolio company is the surviving entity. Making a long story short, and it's a very long story, we have a preference for the Upstream Merger, even though it's more complicated because you are merging an operating company into the holding company. So you are actually, changing the assets and liabilities of the portfolio company and operating company into the holding company. Of course, sometimes the upstream merger is not feasible because of many details, and a downstream merger may be available as well, so that you can push down the debt to the operating company, and you can also push down the goodwill and the asset step up and take the tax shield. The goodwill is something that has been, discussed and scrutinized by the tax administration. Let's be very clear. Not every single acquisition is made equal. There are very aggressive cases, and the tax administration was, let's say, being honest with you, quite right in challenging extremely aggressive situations. But of course, there are situations, fact and circumstances, the fact pattern that helps a lot the structure. The structure gets stronger, and then you are in a very good position to use the goodwill and the asset step up. It's really case by case, but it's something that should be assessed when you are thinking about the structuring, how to make the investment in Brazil. Okay, moving forward here. We have Priscilla again. She's going to walk us through these key topics as well. Priscilla, please.
Thank you, Erickson. So considering everything that we discussed regarding tax structuring and SIP investments, there are some additional topics that must be taken into account when investing in Brazil. The first one is modeling. Brazil adopts IFRS, and the tax legislation is generally aligned with the accounting rules. In addition to that, as Abilio mentioned, the Brazilian tax system is strongly reliant on indirect taxes. So while some industries are subject to a more straightforward taxation, other industries are subject to much more complicated tax rules. So modeling is indispensable, and as far as Brazil is concerned, it is crucial that the tax variables are properly addressed in the financial model, because it will affect your taxable income, your profit, your distributable profits, and your price. And in addition to that, the SPA review from a tax perspective is also very important to avoid unwanted surprises after the deal is closed. And in addition to that, the tax structuring itself affects the deal structure and, of course, the SPA and the other transaction documents like shareholders agreement, debt agreements, and etc. And an additional comment on investment through FIPS is that, as we discussed, FIP structure are usually appealing for investors that are able to comply with the so-called FIP 40% rule. So a typical pension fund or a sovereign wealth fund alone may not be able to use the FIP tax benefits, but it is possible, and it may be possible when the pension fund and sovereign wealth fund is actually investing with other investors. And another comment on FIP tax benefits is that they are not available for Brazilian investors. So this is not the usual route for Brazilian investors, meaning Brazilian companies, but it is possible to partner with other Brazilian private equity funds or even with Brazilian individuals, for instance, private family funds. And at last, another subject that is under the radar of the Brazilian tax authorities is the carried interest received by Brazilian executives. Last year, the Brazilian tax authorities indicated during an interview their plan to assess carried interest structure that are paid abroad to Brazilian executives to avoid taxation in Brazil. We are not talking about carried interest paid abroad to non-Brazilian tax residents. We are talking about carried interest received by Brazilian individuals. So this is a hot topic also in Brazil, and it is important to monitor the position of the Brazilian tax authorities and eventual developments on the legislation.
Thank you, Priscilla. Thank you. So finally, if you guys allow me, one last topic about the structuring, which is the exit. Of course, I mentioned before the situation where, you as an investor, you hold the FIP in Brazil and you sell the portfolio company. The FIP sells the portfolio company, and you get tax exemption on the capital gain. And the FIP is able to distribute the proceeds without any further taxation. Again, assuming the FIP complies with the tax requirements and CVM Security Commission requirements. But here, let's talk about IPO very quickly. Of course, it's not a simple topic, but trying to be as concise as possible. We have two options here on this page. We have on the left-hand side the IPO in Brazil, B3. The Brazilian Stock Exchange, and we have the IPO outside of Brazil, let's say on Nasdaq. So let's talk about the Brazilian IPO first. So if you have the FIP in place and your portfolio company goes public, so nothing changes as far as the FIP is concerned. The FIP can sell the investment on a secondary transaction. The FIP will have the gain, no taxation on this gain. And when the FIP makes the distribution of the proceeds out to the investors, no further taxation again, assuming that everything is compliant with the legislation. You just have to be careful about two things. If the FIP sells and it's a partial sale, and all of a sudden the FIP does not have significant influence anymore over the portfolio company, then we may have an issue, right? Because the FIP, as Priscilla said, must have significant influence over the portfolio company. So sometimes you have a secondary, it's a partial exit, you sell a lot, all of a sudden you have a very small percentage, and this small percentage does not give you any kind of significant influence anymore. You're just a passive investor. This does not necessarily mean that you have a problem, because there are some details in the legislation that we can explore, but it's something that you should pay attention to. Otherwise, we may have a FIP, and the FIP will no longer qualify for the exemption. And when you sell the second stake, the small stake that was the remaining stake as a result of the first sale, you may end up having taxation. And secondly is whether or not do we need the FIP? Because if you have a public traded stocks traded on the Brazilian Stock Exchange, and if you sell the stocks on the stock exchange in a typical transaction, exchange transaction, you may qualify for an exemption as well if you are a foreign investor, right? However, many times we have seen and we have worked with players that we have kept the FIP because why? Later on, 2 years later, if you decide to sell, you don't know if you're going to sell on the stock exchange or somehow you would be able to have a private transaction. You have found out, let's say, a good player, a good buyer, and if it's a transaction that does not qualify as a public transaction, as a stock, as an exchange transaction, you may not be able to enjoy the tax exemption if you do not have the FIP. So many times the FIP is kept alive, even though the company is public, the portfolio company, because you want to have this optionality in the future, either sell on the stock exchange or on a private transaction. And if you have the FIP in place, if you are able to have the FIP in place, you are able to enjoy the tax exemption. Moving to the other alternative, of course, it's not available to everyone, but we have seen many Brazilian companies trying to have the IPO outside of Brazil, let's say NASDAQ, the digital economy, the digital tech companies, and making, again, it's a lot of steps, but some comments. First of all, the location and the formation of the IPO company. We have seen, of course, Cayman company, Luxembourg. Those are the usual suspects, but this is a key component, the definition of the IPO company. Of course, you have to move the structure to the IPO company. The FIP was investing in Brazil. You have the founders invest in the Brazilian company, and everyone has to move upwards to the IPO company. And this transfer, this migration of the investment to the IPO company has to be done very well, very carefully. In case of the FIP, it's something relatively easy to accomplish because the FIP is something, exempt anyway. But if you have your partners in Brazil, the founders of the company, they are Brazilian tax residents. They have holding companies, or they invest in the portfolio company directly as the individual. This has to be well thought of in advance because some tax consequences may arise to your local partners. And of course, if it's not something, let's say, good for everyone, the idea of an IPO on NASDAQ may not fly, right? So the deal has to be good for everyone, the private equity, the asset manager, and the founders as well. It's certainly doable, but it's something that requires much more attention than the FIP, when it comes to the founders. And then we have the question whether or not we should keep the FIP. In principle, the answer is no, unless you have doubts about whether or not, your IPO, let's say, on NASDAQ will take place. If you have second thoughts, it's good to keep the FIP because you can unwind the structure and keep the FIP in the structure and enjoy the FIP exemption. It's not that simple, but yes, you can do it. But if you are certain that the IPO on NASDAQ will take place, it's plan A, B, C, D, E, F, the whole alphabet. So then we can eliminate the FIP without creating, in principle, tax implications in Brazil. And then you have your investment directly in the IPO company, and the IPO company will be in Luxembourg or in Cayman, usually, okay? And then as far as the tax structuring, those are our comments. And I have actually one last question to Sam, my colleague. So Sam, of course, I just spoke about the IPO. So as far as the IPO company, one question that arises a lot when we are assisting clients is, okay, we want to have the IPO on NASDAQ. Can we have the IPO company in the U.S.? So is there should we have the IPO company in the U.S. or out of the U.S.? Is there any preferred jurisdiction that we should pay attention to in this particular setting here?
Yeah, it's a fantastic question. It's really a gating question. So the issue is that U.S. corporations, even after our tax reform, don't have an exemption system underneath them, right? So there's a partial exemption system for things like dividends coming out of the Brazilian company if the IPO company was going to be a U.S. company. But they don't have a complete dividend exemption system, and they don't have something equivalent to a shareholder exemption on sale. So capital gain, if you were going to end up selling part of the Brazilian company over time or restructure things, this is all subject to gain. The second issue is, of course, like Brazil, there's a very strong CFC regime in the U.S. And so this is advantage and a disadvantage, if you will, because Brazil is a relatively high effective tax rate. You could say that maybe it does make sense because we can get a credit into the U.S. for all the Brazilian taxes and maybe even apply one of our exemption regimes for high tax subsidiaries. And that's often done in structuring. So that's not necessarily the issue. The issue tends to be if this Brazilian company, the portfolio company, is a type of company that is a yield company, right, is producing current income, then when that cash comes out of the U.S. company, it's subject to withholding taxes on non-U.S. investors. And Brazilian investors that may be particularly interested, of course, don't have a tax treaty with the U.S., and so 30% withholding tax for round-tripping that cash from the Brazilian company to the U.S. company back to Brazil is obviously a significant issue. And Erickson, as you're talking about private equity, the founders, for example, may end up being large shareholders. If we have yield there and they're getting taxed on that yield and can't effectively use those foreign tax credits, that's a very difficult proposition for them. So those tend to be some of the hurdles that we would work through. Of course, if this is, let's say, a Brazilian company that's a high-tech company or something like that, where it's a real capital play, maybe this makes a lot of sense because you're not, the capital gains are not subject to tax in the U.S. And of course, as you say, NASDAQ, high tech, these kind of things, maybe that would make more sense. So it really is a company by company determination.
Thank you, Sam. Very clear. Thank you very much. So moving forward, my colleagues here, moving forward to value creation. So we had the due diligence, the tax structure, the investment has been made. Now you hold the portfolio company. So let's just few insights about value creation. When I say value creation, I'm referring to tax value creation. We are not referring to operations here. It's not the focus of our webcast here. So few comments. Whenever we think about private equities, asset managers, pension funds, sovereign wealth funds, we focus on the fund structure itself, the structuring of the fund. You can add value there, okay. The investment in the deal structure, and we talked about this a few minutes ago. And then we have the portfolio companies. We have seen a lot of players paying a lot of attention when it comes to the structuring of the fund itself, paying a lot of attention to the investment in a deal structure, the second bubble here. But many times, many times, unfortunately, we have seen, players, private equities, asset managers, private sovereign wealth funds, not paying the same level of attention to the portfolio company after closing. And as Abilio said very well, taxes in Brazil is something absolutely necessary. It may be a source of problem, but may be a source of huge competitiveness. So we try to implement this in some situations in Brazil with some clients, very successful. So basically, our value creation the value creation approach comprises 3 main topics. You don't need to cover the 3 topics, but you at least have to pay attention to these 3 topics. The first one is tax upside, potential opportunities to optimize your overall tax structure in Brazil and minimize your tax burden, of course, in accordance with the legislation. So corporate and tax restructuring, for instance, to use the goodwill or to increase the level of debt of the company. You may have some credits, as Abilio said, PIS and COFINS credits. They are absolutely relevant. Supply chain, it's something relevant. It's a big country. ICMS is the state VAT, and we have to be very careful about how to actually design your supply chain and serve your clients in Brazil. Dividend recap, debentures. So those are just examples of potential tax upsides and opportunities that we can explore after closing. The second topic is risk management. During the due diligence, we sometimes, not always, you have identified a huge topic, something absolutely relevant for the deal and for the portfolio company. So we need to have a strategy to solve or to manage this key, sometimes gigantic tax risk. And then we have the tax compliance. As Abilio said very well, we have electronic filings. The tax administration in Brazil is very sophisticated. Companies, they have to comply with very, very sophisticated tax compliance reporting. So you don't want to create a tax exposure because your portfolio company is failing to comply with the tax reporting and tax filings. In addition to that, still within this topic, tax compliance, many of the companies that you invest in Brazil, you want those companies to become a platform, for growth, right? So all of a sudden you have a company that is, a mid-sized company in Brazil, you have an investment from a private equity fund, and then the company starts to buy other companies and grow, and nobody thinks about the tax department. So it's impossible for the same tax department that was there serving a mid-sized company to serve well a company that is growing tremendously every year by means of acquisitions, for instance. So you need to think about technology, processes, people, procedures, how to make sure that you have a tax department that will be able to comply with the legislation. So just to give you guys a kind of framework, a very short description of our framework to add value after closing to your portfolio company and to your investment in Brazil. Okay, and moving forward, then we have some comments. Of course, we don't have crystal balls. Priscilla will help us here to briefly talk about some of the potential changes that may occur in the Brazilian legislation that are relevant to asset managers, private equity, sovereign wealth funds, so on and so forth. Priscilla, please.
Sure. So there have been some recent developments on the Brazilian tax reform topic. We have different bills at Congress, but we will focus today on the draft bill that was delivered by the federal government to Congress, which is supposed to be the first step of a wider tax reform that is being proposed by the federal government. So the first phase of the Brazilian tax reform that was designed by the federal government would be the creation of CBS, a social contribution on goods and services. CBS would replace PIS and COFINS, the existing PIS and COFINS, which are charged on gross revenue on and import transactions at different rates and different regimes. One of the main reasons for the conversion of PIS and COFINS into a single tax would be to reduce the overall tax burden and reduce litigation, considering that, as Abilio mentioned before, PIS and COFINS are one of the main source of litigation between the tax administration and the taxpayers in Brazil. So overall speaking, apart from a few exceptions, the taxpayers would be generally subject to the same rules, the same regime, and in the same tax rate. CBS would be charged at 12% rate on sale and import of goods and services, on royalty payments, and transaction with intangible assets. Although the federal government claims that their intention to reduce the overall tax burden, the truth is that depending on the business and operation of the Brazilian entity, it might be actually subject to a higher tax burden. As a matter of fact, some sectors will be directly affected by CBS, for instance, real estate, services, and infrastructure. So in any tax reform, there will be winners and losers to this potential change. And with regards to private equity funds and asset managers, CBS will not affect the investment structure, but will definitely affect the portfolio companies. The draft bill for CBS is still on very early stages and will have to go through Congress. So the timeline for approval remains uncertain, and changes are expected to the original text that was submitted to Congress. So our suggestion is to monitor the discussion within the Congress, and as soon as we have a better view of the potential final bill, our advice is to start modeling the implications, the financial and P&L implications to the portfolio company, so you are able to anticipate and plan eventual changes and be ready to benefit from eventual opportunities. So moving to the next slide, please. So as I mentioned, the federal government presented their vision as to the Brazilian tax reform, which is supposed to be divided into 4 phases. The first phase is the replacement of PIS and COFINS by CBS, which we just talked about. This is the only step that has been proposed to Congress so far, and the draft bill for the other phases has not been delivered yet. So as far as the second phase, it is expected that the government will propose an extension of CBS to include the existing excise tax, IPI, tax on financial transactions, IOF, and also the contribution for intervention in the economy. Under phase 3, although it is not clear the details of the government's proposal, the backbone should be the decrease of the corporate income taxes rate and reestablishment of taxation on dividends. And in addition to that, it is also expected that there would be changes to the individual income taxation. Of course, this subject is extremely relevant to all investors, and it will affect the profit distribution and exits. And at last, under phase 4, there would be a reduction in the payroll taxation and introduction of a new tax over financial transactions, which is similar to a tax that we had in the past, the CPMS. Back to you, Erickson.
Thank you, Priscilla. So now we have our Q&A session. Of course, we have some questions here. Unfortunately, as usual, we are running out of time, but we have time for a couple of questions. So the first one is to Sam. One question that I have here is, the U.S. had a tax reform a couple of years ago, and now you are in the middle of the election, and let's put aside any political issue here, but tax-wise, if one of the contenders win, is it fair to assume that a lot of changes will occur in your legislation that could affect our overall M&A and cross-border transactions? How do you see that? I know it's a very crazy question in a few minutes, but if you could give us your view on this, that would be great.
Yeah, of course. So there's certainly a statistical possibility of a Democratic administration as well as Democratic Senate and the House being retained by the Democrats. So one thing that we look at is what would a Democratic Congress and a Democratic White House do to change the tax legislation, and we expect some pretty significant changes. We don't think it'll be as wholesale as the changes we saw in 2017, but we do anticipate that certainly individual rates may rise. Importantly, for cross-border M&A, we are thinking that there may be some changes to carry taxation. There may be some changes to capital gains taxation for high-income earners. These have both been proposed by the Biden administration and are things that are maybe relatively easy to do compared to some other things. From a corporate perspective, we think that the rate could go up to something like 28%, and that's certainly been proposed and a relatively easy thing again to do. Other things like estate tax changes, inheritance taxes, likely to be talked about. The news and really from both sides of the aisle, people have been commentators on tax matters have been saying that these are reasonable reforms. If we don't have a change of the Senate, which is statistically less likely than at least current polling than the change of the executive, then we probably won't see any kind of material significant changes. So there's a lot riding on the outcome in terms of the amount of change. But the biggest change we would probably see is the taxation of managers when it comes to all of this, and some of their incentives around tax are the ones that are currently being looked at.
Thank you, Sam. Very clear. Very clear. So one additional question here to Abilio. Abilio, given everything that you described to us about the tax environment in Brazil, the due diligence, from a practical perspective, based on your experience, usually the due diligence exercises in Brazil, they start with a first phase approach, red flag, high-level analysis, and then we have a second phase where you dig into the details or no. What's your experience on this?
Well, it kind of varies a lot depending on the amount of knowledge that the buyer already has on the target. If they're just starting the analysis, not uncommon to have a phased approach. So first a high level and then a full-blown exercise on phase two. In any case, what we tell our clients, considering everything that we discussed, is don't complete the transaction based solely on a high level due diligence. The high level due diligence would be more of a red flag report, just to say go or not go. Unless, of course, the investment is so immaterial to you that you are willing to take the chance that there is something there because it won't matter anyway. Use a phased approach if you're trying to still decide, but only don't do only a high-level analysis. Do a complete exercise because of the various things that we have discussed.
Thank you, Abilio. One last question. The question is to Haddad, Roberto Haddad. The question goes back to the role of private equities and asset managers in Brazil. Looking at the next 12 months, 2 years, of course, we know that you don't have a crystal ball yet, but but what's your view on the role of private equities and asset managers in Brazil in the next couple of years, let's say, given the overall environment and economic landscape?
Well, as I mentioned in the beginning, we see that in Brazil the percentage of investment of private equities compared to the GDP is low when you compare to US, for example. I would say that it's quite a common sense that we expect an increase of the participation of the private equity funds and venture capital in the amount of investments in Brazil. So this is one thing. The other thing is that we have been seeing the PE houses increasing investments in some areas that are booming in Brazil, like for example healthcare. So they're investing a lot in hospitals. They're investing in all kinds of labs and so forth. We also see them investing in education, retail. But one thing that is critical is that we have a big plan of privatizations in Brazil. And these are huge investments. For example, we just had the regulatory mark on water management, and we expect a lot of privatization on that. And we know that there will be a lot of JVs, and we know that in most of these JVs we have at least one private equity fund investing with, for example, strategic investors and so forth. So what we have been seeing in the last months is that these JVs in the large infrastructure investments are increasing, and I think that it's fair to say that it will increase even more and much more over next months and years because of the infrastructure plan and the expected privatizations in Brazil. So I would think that when you ask the role would be more relevant and more significant than we have been seeing in the last years. So that's almost a good. I would say that's fair to say that.
Thank you, Roberto. Thank you very much. So we are coming to the close of the session today. To those of you who have raised questions and we have not answered, we are going to reply to you directly via email. I would like to thank everyone for attending the session. Please, we have a feedback survey. If you could take a few minutes to reply, to answer this survey, it's very important for us to improve our webcasts. And just a reminder that we will also distribute the webcast slides and play back the audio in the next 48 hours. And finally, thanks also to our speakers and also to everyone that joined our webcast today. So thank you very much. Have a nice day and be safe as well. Bye-bye, guys. Thank you.